Welcome back. And in our top business story, banking experts say that about $120 billion will be spent on infrastructure projects over the next 10 years in the GCC, despite the pressure over the world economy. The GCC states are investing heavily into infrastructure development to pave the way for economic growth in the coming years, according to banking leaders. Dr. R.C. Tharaman, the group CEO of Doha Bank, says that the Gulf economies have responded well to the crisis and that Dubai is bouncing back on track. FDI in the MENA region for 2010-2011 stood at $128 billion. And the Doha CEO added that regional banks are becoming more active in project finance, given the size and volume of projects in the region, as shown by active deals in short-term financing and an increased appetite for longer-term facilities. The strength of the UAE economy, he says, is due to growth in areas such as human development, education, trade, hospitality, and improved cash flow.
The UAE economy as a whole has been in a positive trajectory, and in terms of macroeconomic fundamentals, they are strong. If you look at the GDP breakdown, they're going to report not less than $400 billion, and they're going to run not less than 12 to 15% current account surplus. 55 to 60 billion will be the current account surplus. UAE economy as a whole. In concept, the per capita is moving in the right direction between $65,000 to $70,000. So purchasing power is improving. Re-regulation has taken place in terms of consumer protections. So banks are getting stable and functional. Capital adequacy norms are well governed. So it is a very interesting resurrection in a way. The Gulf economies are responding to changing dynamics, and it's an opportunity looking at the global frame. Gulf economies still holding fiscal and current account investable and sovereign funds.
The Dubai International Financial Centre is developing a new Silk Road with China after great interest from the Chinese institutions looking to come into the region to benefit from promising growth opportunities off the back of the DIFC's latest trip to China. A senior DIFC delegation has been discussing the role of Dubai as a financial and logistical hub for Chinese investment into the Middle East and Africa after a visit to Beijing, Shanghai and Hong Kong. Jeffrey Singer, the CEO of the DIFC Authority, was quoted as saying that China and the Middle East have been important trade and investment partners for centuries. But it was only relatively recently that volumes have risen dramatically and that the DIFC is the ideal jurisdiction to access this opportunity. Middle Eastern mergers and acquisitions are at a 2-year high, according to a new report, and have grown fivefold on a year-on-year basis. The value has risen from $1.7 billion in the third quarter of 2011 to $9.6 billion in Q3 of this year. That's according to Bureau van Dijk's Zephyr database. According to a local paper, the report reveals that the latest quarter has delivered the strongest performance for the Middle East region in the last 2 years. And deal making is up 463% year on year. And it is also up 153% quarter on quarter from $3.8 billion in Q2 2012. Qatar led the region by value, bringing in $3.9 billion of deal making. Kuwait then followed with $3 billion and Saudi Arabia came in third with $19 billion. And let's now take a look at the stock indices across the GCC.